Hey, everybody. Thanks for hopping in, spending some time with us this Tuesday afternoon. I'm going to give it just a minute or two, let everyone join, get settled in, and then we'll get off and running. Thanks a bunch. So I'll go ahead and get going. I know we've got a lot of stuff we want to squeeze in. This is recorded as well, so I will send it out to all of the attendees who maybe will join late or had something come up on their calendar. Nevertheless, thanks once again for hopping in, spending some time with us. This afternoon, I'm joined by the team at GromaREIT. Super excited to hear their innovative twist on the traditional real estate methodology and very exciting opportunity behind it. My name is Greg Bomberg. I lead our investor relations here at Republic. I'm representing Open Deal Broker today. Groma is actively raising with Open Deal Broker, and this is an opportunity that's open to all accredited investors on the Republic platform. Super quick on the event page and on the Zoom registration, you're able to view our client relationship summary if you'd like. It's also worth noting that everything you hear today is not investment advice. Private investments can be risky. Past performance is not an indicator of future returns. And as always, we encourage every investor to do their due diligence before making any investment decisions. So now we got all the housekeeping out of the way. I'm really excited, joined by Seth Prebach and Christina Dorbeck. Seth is the president of Groma, and Christina is leading their investor strategy efforts. So super excited to hear from both of them. This is going to be a pretty conversational setting. They've got a lot of insights that they're going to share with us about the industry, about their company specifically, and some of the changes that we're seeing on a macro environment level as well. So with that said, I would love to pass it over to you guys to give some quick introductions, tell us a little bit about yourself, and then we'll get into the nitty gritty after that. So Seth, you want to tell us a little bit more about you?
Awesome. Yeah, thanks for having us. And you've got the two of us here. Myself, Seth Prebach, president of Groma, Christina Dorbeck, our head of investor strategies. Hello. And Christina and I have actually worked together for well over a decade. And actually, probably I'll kick it over to you if you want to give some of our startup history together, and then we'll dive into Groma a bit from there.
Yeah, perfect. And Greg, thank you for taking care of all the housekeeping. Makes it easy for us to do our intros. Yes, exactly. So hi, everyone. I'm Christina Dorbeck. As Greg and Seth mentioned, I lead investor strategies, investor relations here at Groma. Seth and I have worked together for coming up on 14 years now, so the better part of a decade. I'm originally from California. If there's any LA residents watching the webinar, I'm still a Dodgers fan, not a Red Sox fan. And I came out to Boston, where Groma is headquartered, to attend Wellesley College. I started my career in nonprofit development, nonprofit fundraising, and worked at a company called the Center for Women in Enterprise, which was focused on helping women become economically self-sufficient through entrepreneurship. Now, decade plus ago, Highland Capital, who was one of CWE's sort of venture partners, made the connection to Seth, and I joined Level Up as one of the founding team members overseeing our revenue functions there. Level Up was a technology company that was really focused on helping restaurants use technology to grow their business, and we grew Level Up over 10 years or so to be about $1 billion in restaurant sales, and ended up exiting that company to Grubhub in 2018 for $400 million. Seth and I and most of the Level Up team stayed on at Grubhub for another few years and helped grow the Grubhub business. Navigated food delivery through COVID, which was a very interesting time, and ended up exiting Grubhub to Just Eat Takeaway in 2021 for $7 billion. So two really exciting exits over a decade plus. Today, Seth, a number of other Grubhub team members have paired up with executives with deep real estate expertise, and we are here together at Groma, really bringing a lot of our technology and logistics experience to our real estate innovation trust. And we'll obviously talk a little bit more about how we're sort of merging technology and real estate together at Groma. But with that, I'll let you
Awesome.
introduce yourself as well, Seth.
Yeah, and again, Greg, thanks for having us. Great to have everyone on the call today. As Christina highlighted, the bulk of our history overlaps, so I'll keep my intro comparatively brief. The only parts that we don't overlap on, I went to Princeton for a year. I did not graduate. I'm a proud Princeton attendee. As part of where the now somewhat more muted orange has come through my career. Ended up winning the business plan competition my freshman year with the company that ended up becoming Level Up, and then, much to the chagrin of my mom, but she eventually forgave me, dropped out and went on a great startup adventure over the last decade or so, and now have really brought back together a number of team members from those prior enterprises to focus on what we're building here at Groma, which we're really excited to tell you more about today.
That's awesome. Well, thank you both. And yeah, I feel like working in tech, dropping out of college is a badge of honor. So
almost a requirement these days. That's what you got to do.
Well, that's awesome. Thank you both for the introductions. It sounds like you've got, a vast familiarity in several industries that were, pretty affected by COVID. And, I'd love to dive into a little bit more about that later on. But let's start with the simple stuff. What is Groma? Where did the idea come from? Give us a little bit of the rundown there.
Absolutely. So the core of Groma is really about using real estate and technology to make our properties work better for our residents, for our investors, and for the communities that we serve. To make all that happen, we've launched the GromaREIT. For those who aren't familiar with what a REIT is sort of a specialized type of company that focuses exclusively on owning real estate. REIT, the acronym REIT, stands for Real Estate Investment Trust, though in the context of Groma, we call the GromaREIT the Groma Real Estate Innovation Trust. A, because who doesn't like a good play on words, and B, because we really do pride ourselves on innovating in two key areas. One, our specific focus on property technology to make a historically overlooked asset class, these sort of small unit count multifamily assets that make up the backbone of housing in many major cities across the country. We use technology to make those run more like an institutional asset, to make them run more cost effectively, and really focus on bringing a lot of the skills and tools that we used in our prior careers at Grubhub and Level Up to this new asset class. The second innovation we focus on is accessibility, right? Something that really aligns with Republic's mission, not only taking these assets and making them perform better at scale, but making them accessible at scale, so that we can invite in investors all the way from institutions to the renters themselves in our buildings, and give everyone the opportunity to own a little bit of the city around them. That's really the core of the Groma mission, of the GromaREIT. And in many ways, it's a continuation of what Christina and I have done over the last decade or so. At Grubhub, it was all about using technology to bring efficiency to restaurants. We often tell the story of being a single owner operator restaurant, and there you can actually do delivery efficiently. You can hire your nephew or your cousin and give them a bicycle and ask them to run a pizza down the road every once in a while. But as soon as you start to hit scale, if you grow, if you open up a second location, you suddenly need a lot of infrastructure to make these things that are basic at a one-off work well at scale. When you're up at the scale of Domino's, suddenly you can do it well again and do it efficiently. But that middle market really suffers a lot of unique challenges, unique stresses, and that leads to a lot of inefficiency. When we graduated from Grubhub, sold the company, graduated, we saw a similar opportunity, perhaps even a bigger opportunity, in using those same techniques to bring efficiency to this small unit count multifamily asset class, 1 million plus buildings all across the country. And we got the team back together and decided to try and build a great business that could do a lot of good by making these buildings perform better for residents and investors, and building it in such a way that everyone has the opportunity to participate. So that's kind of the core of what we're up to, and appreciate the opportunity to share the story a little bit.
That's great. Well, thanks so much. And I heard you focus a little bit kind of on that the middle of the market there, right? You've got the single family homes, and then you've got these large multifamily units, but then potentially neglected, just right there. They're sitting in the middle, maybe that 2 to 20 range, that unit building. Tell me, I guess, a little bit about that specific type of residential real estate, and what gets you really excited about it. What's the opportunity that you've identified?
I'll take this one. you hit the nail on the head. We actually call sort of that the asset class that we focus on sort of the missing middle. But when we're thinking about residential real estate, there's sort of three ways that we would break that down. There's traditional multifamily, which is really 50+ unit apartment buildings. There's the single family rental market, which is 1 unit buildings that, single family homes that people are renting. And then Greg, as you mentioned, there really is sort of that middle market, often called the missing middle housing, which is that 2 to 50 unit opportunity. When you look at traditional multifamily real estate, 50+ units, that has been heavily focused on. Right now, it's about 41% owned by institutional investors. And we're seeing that same trend happening in the single family rental market, which is on track to be close to the same institutional ownership in the next 5 to 7 years. But that missing middle really hasn't been institutionalized yet. And so Groma's focus is even narrower within that missing middle, 2 to 50 units. We focus on 2 to 20 units, an asset class that we call modern urban rentals, or MURs. And modern urban rentals are upgraded experiences in non-amenitized 2 to 20 unit buildings in dense urban cores. There's a lot of similarities to the single family rental, which we'll talk about throughout our webinar, but a lot of differences as well. Obviously, they're multifamily buildings, they're located in dense urban cores, transit oriented, and they come with some really unique operational challenges that really require a technology solution to help manage them at scale. Today, Groma owns about 50 of these modern urban rentals in the greater Boston area, and have built a tech platform to really reduce the operating expenses and help them run more smoothly.
Yeah, no, I mean, that's great. And obviously a really astute observation there with kind of the gap in the market. That's how a lot of industries, established industries, are disrupted and innovated. So I think that's really great. I mean, when we zoom out just a little bit to kind of take a view at a macro level of the whole real estate economy right now, what are some of the trends that you're observing, and how, I guess, are you guys prepared and set to capitalize on those?
Yeah, so I'll tackle this one, and I think this is a really interesting question, given just the rapid changes we've seen in the economy over the last really 3 years, right? It's always changing, but the last 3 years, I think we've gotten every flavor of economic environment in rapid succession. And as we've kind of been building Groma through that, like all good companies, we've tried our best to study the history of the space that we're in and understand what impacts came before and are causing the market to operate the way that it does today, and how that might inform the future. I think this topic particularly is actually aided by some slides that we put together. We're going to try to mostly keep this focused on us and a conversation, but if we can pull those up, there's a few interesting trends that I think are worth highlighting here that give a little bit of context to the MUR space that Christina was highlighting, and why we think these sort of small unit count multifamily assets are in a really interesting place to be aggregated and optimized over the coming years. Christina had highlighted that the MUR space, the modern urban rental space that our technology platform focuses on, has a lot of parallels to the SFR space, the single family rental space that probably many of you on the line are more familiar with. It's been a rapidly growing ecosystem over the last 10 years, and it really came into existence back in the 2008 crisis, in the global financial crisis, in large part because a huge supply of discounted, often foreclosed or sold at a discount under stressed scenarios, single family homes came onto market. What you can see on the slide here is some data from the Federal Reserve, from their FRED data system. And this is the Case-Shiller Index. It's a pair of economists who put together a pricing index to track the relative cost of single family homes across the country. And from 04, 05, 06, 07, 08, housing prices were going up, one might argue somewhat unsustainably. And then during the 2008 financial crisis, they really came crashing back to earth. During that time, obviously a very challenging time for millions of people, there were something like 3.8 million homes that got foreclosed and were sold at auction. That is a staggering number of homes. To put that in context, that's more homes than were built in the US between 2009 and 2014. So it's a huge amount of inventory that got put on the market and got put on the market at a discount. And whenever that type of market disruption happens, there are lots of enterprising companies, entrepreneurs that look at it and say, hey, how can we make some progress out of this really challenging situation? And that is in large part what spurred the single family rental market into existence. Groups like Blackstone, Invitation Homes, others started buying these homes up by the thousands, and there wasn't a market to sell them, so they weren't flipping them. They turned them into rentals, and now there are hundreds of thousands of homes that are owned by institutions and are part of this single family rental ecosystem. If you fast forward a little bit, and maybe we can go to the next slide, to what things look like today, we're in the midst, or maybe hopefully at the tail end of another financial crisis. This isn't the 2008 crisis, right? It's not the global financial crisis. It's maybe what you could call the COVID financial crisis, right? It's really driven by a pandemic and the government's reaction to that pandemic. And any type of major economic impact like that has knock-on effects, and real estate being such a big part of the economy has knock-on effects on real estate specifically. Part of what we're studying and what got us excited about this MUR space is that the government's reaction to the global financial crisis kind of created this large inventory of single-family homes at a discount, spurred the SFR market. The government has made progress, maybe gotten smarter, and this time around, thankfully, there were not millions of foreclosures, right? That had a real human impact, and economically was not a good thing. And so there were a lot of government programs that supported homeowners, and the number of foreclosures this time around has been fractional, right? Not quite zero, but you don't read about it in the news, which is good. In large part, foreclosures were just not allowed this time around, and homeowners received the support they needed, as did renters, as did many other people. A natural effect of that is that the price of single-family homes, which course-corrected after 2008, did not course-correct after 2020. You can see in the top right section of this graph that maybe home prices went down for a half second and then went straight back on their somewhat meteoric rise. That might be bad if you're looking to buy a home. It's certainly challenging if you're an institution looking to buy single families and turn them into rental properties. But it also creates a kind of next area of focus, which is what we think opens up. This focus on the next up asset class. Those 2 to 20 unit properties that are not quite single families, are pre-existing rentals. Suffer from some of the inefficiencies that existed in the SFR space prior to 2008, but are now available and much more available at entry points and price points that make them, we think, exciting for institutional investors. If we go forward one more slide, some of that data that I was highlighting, you can see on this chart. To explain the chart a little bit, the blue line is the cap rate of large multifamily assets. Cap rate is a measure of return, essentially how much net operating income you're earning for the price of a building. So if it's $1 million building earning $50,000 in profit every year, it might have a cap rate of 5. The blue line is the cap rate for large multifamily. The yellow line is the cap rate for small multifamily, which is what we focus on. And the green line is the cap rate for single family rentals, which we don't focus on, but we've been talking about a whole bunch here because we think it's the leading analogy for the MUR space. You can see the trend line of the single family market being a pretty impressive decline, which in cap rate terms actually means the value of those assets has been going up. There's more desire for them. And we think that in this next couple of year period, and if you jump forward one more slide, there is going to be continued focus from individual buyers on stepping into the single family market. Right, a lot of pent up demand, not a huge amount of supply. That's driving the price of single family homes up and the cap rate, the return, down. We're seeing similar trends to what we saw last time in the global financial crisis for large multifamily. Some decrease in prices, but overall, a relatively steady trend. And what we're seeing in this small multifamily space, the 2 to 20 unit space, is that there are really unique stressors. There are a lot of individual owner operators who are retiring, who are looking to move to a less effortful business, and they're selling those assets onto the market at discounts that are somewhat equivalent to what we saw back in the 08 crisis. And that is kind of the 30,000 foot view, or maybe depending on how detailed we got here, 20,000 foot view of some of the macro trends that we think are really driving this unique opportunity that we're focused on to do an institutional roll-up of these small unit count assets as we head into the next year or two of the post-COVID financial ecosystem. 18,000 foot view, halfway between the two.
Yeah, I mean, it's all really fascinating. And it's, I think when you see industries like this just focus on certain like subsegments, it's definitely an opportunity for those that might be neglected and maybe historically inefficient as well. I'm curious, and, we've seen this with finance as well. You have large numbers of institutional investors, and now we're trying to give access to, common investors as well. And so you see the incorporation of tech help to fuel some of this innovation and gain access across different industries. I'd love to learn a little bit more, from a tech perspective on your side. How is Groma leveraging that technology, and what trends within property tech are you observing and trying to capitalize on?
Yeah, absolutely. So Groma's leveraging a number of different sort of trends within the broader prop tech landscape, and we've also built some proprietary technology ourselves that is specifically focused on the modern urban rental opportunity. Really, our real estate platform is focused on helping us acquire, upgrade, and operate modern urban rentals. And so I'll sort of talk through an example of how we use technology at each of those stages. And Seth, of course, jump in if I miss anything.
Will do.
But one of the first ways that we use technology is on acquiring these properties. And Greg, I think I actually only half answered your question before, which is I think I answered what is a modern urban rental, but not why we get excited about them. Obviously, one of the reasons we get excited is because we think there's a great opportunity and the ability to use technology to really deliver on that. But the other reason is because they're great assets. So there's, in just Boston, 15,000 of these buildings. That also poses a pretty significant challenge on the acquisition side. You can't use, sort of the traditional analyst method to be able to diligence these buildings efficiently. And so what we've built is a machine learning driven auto modeler that pulls in data from 30 different third-party, 30-ish different third-party data sources, integrates our own first-party data because we own 50 of these buildings in the Boston area, and helps us look at any of the properties that are on market. And let's say there's 100 properties on market. Our machine learning driven auto modeler can actually eliminate 95 of them, whether it's a building has a physical attribute that makes it functionally obsolete, whether the price that they're listed at just doesn't work with our return criteria. That allows our acquisitions team, so we never buy buildings sight unseen, but that allows our acquisitions team to now look at the 5 properties that could work for the GromaREIT and actually spend that human diligence time on those properties. So that's sort of the first way that we're using technology, and we saw a lot of acquisitions tech develop in the single family rental industry as well. But that's sort of the first piece on the how do we acquire these buildings efficiently. The second piece is we talked about modern urban rentals are really upgraded experiences in these 2 to 20 unit buildings. And so we renovate all of our buildings to a similar standard we call the Nordic standard. There's 3 levels of finish, Nordic Essentials, Basics, and Luxe. And we do that so that we can bring a lot of standardization and efficiency to these buildings, but we're also integrating smart home technology, obviously another big prop tech trend, into these buildings that gives our property operations team, well, provides a better residence experience. You don't need keys, you have smart thermostats, but gives our property operations team a lot of capabilities in terms of remote management. Just yesterday, I guess it was below freezing here in Boston.
First time here in Boston, a little bit of snow already.
So as we're heading into the winter months, and especially leading up to the holidays, it's often a time when we are trying to manage potentially unexpected costs like a burst pipe, and times when residents may be traveling. Our property operations team has the ability before Thanksgiving holiday, before the winter holidays, to make sure that all of our units are set to 60 degrees and really prevent any potentially unforeseen issues like a burst pipe that could really cause a lot of inconvenience for tenants, but also a lot of costly damage for our properties. And that's just one sort of anecdote of how integrating smart home technology can really give our team a lot of remote management efficiencies. The third piece that we were talking about is operating these buildings efficiently. And I'm like smiling at Seth because there's a lot of Grubhub analogies here, but we've really built an entire logistics infrastructure to manage resident requests. So these buildings are different than a traditional multifamily, where you might have, a 100-unit building with an on-site maintenance tech or super that can manage resident requests really easily. These are 50 buildings that are, located densely across greater Boston, but have tenant resident requests that are coming in that we need to manage. And so we have a digital ticketing system as one piece of our logistics infrastructure that allows us to respond to any resident request immediately, but we can also categorize those tickets so that urgent requests get addressed immediately within a few hours, but non-urgent requests will be, again, responded to immediately, but can be resolved within a week, 10 days when we have a maintenance tech that's going to be in that area. So we can consolidate our ongoing maintenance visits and really reduce costs in that manner. It's essentially Grubhub-like gig maintenance is sort of, again, one example of how we're using prop tech in our logistics infrastructure to make operating these buildings much more efficient.
And I mean, I think that last point really, bears hitting on twice, in that when we acquire these assets from the existing owner, owners or operators, they tend to be, small individual operators, maybe a dentist or a doctor who bought one and manages it, him or herself. They tend to have in-place expense ratios, i.e. the percent of every dollar that goes to operations, taxes, insurance, other costs, of between 45 and 50%. After 2 or 3 years on the Groma platform, the average from our first 39-40 buildings, we were able to bring those down to operating expense ratios in the 30 to 32% range. That might sound big or small, depending on how you think about it, but in terms of actual results and value of cash flows and the overall value of the building asset, that's a really material reduction, right? It's instead of giving away 50 cents of every dollar to expenses, you're only giving away 30 or 32 cents of every dollar, and that just dramatically increases the asset value, the cash flow of each of these properties, while also delivering a better resident experience, right? The things that are expensive tend to also be undesirable for the residents, things going wrong, leaks, boilers not working, whatever it is you have to fix. And the combination of our proactive and reactive management and maintenance stack has enabled us to deliver what we think are really impressive results in a historically less efficient asset class.
I'm glad you doubled down on that. For anyone who's looked at the Groma offering page on the Republic platform, there's also a great case study that sort of walks through an example of a single building and how the tech stack we have reduces operating expenses and also helps increase revenue as well. But thank you for nailing that one.
And those are efficiencies that probably could not be achieved, 5-10 years ago. And so you look at this model, you've got the acquisition side. So you're really improving and speed it, like adding speed to the diligence process for how you even scout these units, and then upgrading it, which is going to inevitably reduce the churn in these units, add value to the property, and improve the experience all around. And then, of course, operationally, we've all had terrible renting experiences. And so if you can add tech and you can be proactive for some of those unforeseen events, then yeah, I think, full circle, those are three really good progs to kind of focus on. And, we've talked a little bit about tech. We've talked a little bit about macroeconomic trends and patterns that we've observed. And so just kind of really to drill in on the timing of all of this, the opportunity, what you guys have built. Kind of talk about, and I'm sure COVID will be, slightly relevant here as well, but talk about why the timing is really right for Groma to take advantage of this opportunity.
Yeah, so it's a great question, and as with many opportunities, it's kind of a confluence of a few things coming together all at once. One, as you highlighted, is the technology now exists and can be built, can be integrated in such a way to make these assets really efficient to manage at scale. When they're decentralized and kind of remotely scattered around a city. Back in 2008, 2009. Many of these sort of last mile logistics delivery players that are now very common, things like a Grubhub and Uber, just didn't exist. And so the ability to route maintenance technicians around efficiently, obviously it could be done, but it wasn't as available, wasn't as commonplace, is something that exists now that we can leverage, that we can essentially reuse to run this asset class at similar levels of efficiency to a building with 300 units in one tower. The second thing that's really enabling this opportunity are some of the macroeconomic conditions that we talked about. Significant rise in interest rates, which has depressed the asset prices of these buildings. Some operational challenges that tend to favor larger operators versus smaller operators. Efficiency of maintenance and logistics is a big one, but some things are just now more affordable at scale, right? Insurance, for those who follow the real estate and the insurance industry specifically, insurance costs for buildings have gone up, as high as 30% since the beginning of COVID. That really is a challenge for operators, big and small, but it's a comparatively more difficult challenge for smaller operators because they just don't have the ability to negotiate in bulk in the way that an operator like Groma might be able to. And the third major trend that we're seeing and that we're kind of leaning into is around consumer preferences. There's a real demand for people to come back to cities now. During the beginning of the pandemic, if everyone remembers, there was a real emptying of cities. For the first time in like 30 years, rents in New York City and other major cities actually dropped pretty precipitously because a lot of population naturally went to the suburbs, went to the exurbs to not be in those dense urban cores. That feels like forever ago, but it was really only 2 or 3 rent cycles ago, 2 or 3 years, not that long in the real estate world. That's the blink of an eye. And now there is this return to a desire for, mid-density, transit orientation, walkable cities, and these MUR assets are perfectly positioned for that. They're, really wonderful places to live. You can walk to a metro station. You can bike to work. Not always, but they are generally in dense areas. You can walk to restaurants and other amenities. The city really becomes your amenity, and we think the confluence of those things is really what's driving this opportunity to be particularly exciting for us at this moment in time, and we think those conditions will last for the next couple of years. So potentially a promising time for us to be out in the market and continuing to build the Groma ecosystem.
Perfect. Yeah, that makes a lot of sense. And actually, I'm going to sidestep into an audience question super quick. On that note, you talked about some of the, the infrastructure in these cities that is making them good candidates for you to expand. You're in Boston right now. What is super quickly, the expansion plan look like? Any other cities that are on your radar?
Yeah, great question. So we, for first sort of thing that we look at when we're targeting a next market to expand to is there enough inventory of these 2 to 20 unit non-amenitized buildings? Turns out there's 30, 40 so cities with enough density in the United States alone. As I mentioned, there's 15,000 buildings just in Boston. If you go to New York, one of our likely next expansion markets, there's 42,000 buildings in Brooklyn alone. New York is, a country when it comes to these asset class buildings. So likely we would look at Brooklyn, Queens within New York, Philadelphia, Pittsburgh, are probably, top, yes, candidates for the next market. I was going to say top 4. But there's really, across the country, LA, San Francisco, are other markets that have a significant number of these buildings.
And I think that's a big strength to the Groma platform, that while certain elements of our operations have to be localized to each city, right? If you've got to fix a faucet, you need a maintenance technician, in range of that building. So we will always have pods of property operations team members in each city. The underlying technology, the auto modeler that Christina highlighted, the renovation stack, the property management and logistics stack that we've built, all of that scales really nicely. Similar to, Grubhub had to have operations in every major city, but the core of the technology that we built was really replicable. And so as we get it working, and we feel we now have it working well here in Boston and the greater Boston area, we think there's a lot of embedded advantage and efficiency to scaling from one MUR city to the next.
Yeah, all that makes a lot of sense. So I'm gonna actually rewind maybe a topic or two and go back to the institutionalization of this asset class for just a minute. And this could be a controversial question, but I think it's important to ask. What do you say to people who argue that institutional ownership of small real estate assets is bad for, even really society, or it's depriving home ownership opportunities? What would be a reply to that?
Yeah, I think it's a great question, and you're right that it can be a little controversial. I think Blackstone and others that were very heavily involved in sort of the forefront of the single family rental trend, I think got a lot of headline heat for that. And one of the big differences in modern urban rentals is that most of these buildings are rentals to begin with. Sure. And so we're not depriving home ownership in that sense because they're multifamily and already rentals. But I think there's some other good sort of differences to talk through there. Modern urban rentals are really located in dense urban cores, and we're sort of seeing some interesting trends with them. And oftentimes they're sort of succumbing to a barbell fate where either they're getting purchased by developers and sort of converted into luxury condos, or they're, sort of becoming more dilapidated over time. And so we actually think that the institutionalization of these assets is serving a net benefit. We're actually helping to upgrade and preserve really essential workforce housing in these dense urban cores. Most of these modern urban rentals sort of qualify as naturally occurring affordable housing. And so we sort of think of it as, really maintaining that essential workforce housing in major metros.
And I think the second point to build on what Christina just highlighted is, it is a different asset class. It has different underlying mechanics. It has different, existing individual ownership, owner-occupier criteria. But also the second part of Groma's stack, I think really aligns with something that is obviously near and dear to Republic's mission, which is democratizing ownership of the underlying assets themselves. So very different from SFR, where you're taking an asset that might be owned by an individual and bringing it into, a centralized, institutional warehouse. Here, we're taking an asset that generally was a rental asset, an investment property in one way, shape, or form. We're managing it more efficiently. We tend to think we're providing a better resident experience. We certainly strive to. And unlike a Blackstone or an Invitation Homes, we have an embedded focus from day one on democratizing access to that underlying asset. Sort of the ideal scenario for us would be to have the renters in our buildings also be owners of the GromaREIT, and both benefit from the growth of the ecosystem and be able to live in a great place that meets their needs day in and day out.
Yeah, I think that makes a lot of sense. It's an easy to critique to understand, but I think you flip it inside out, and you're actually providing opportunities for this access. And I think, Christina, you made a great point at the beginning. These 2 to 20 unit buildings were very rarely sought after by somebody who's looking for that single family home. So it makes a lot of sense, and that's a great reply. Would love to learn just a little bit really quickly here about, I guess, the how does the modern urban rental differ from the single family rental, and are there unique benefits to this, to the difference that fits into your strategy?
Yeah, it's a great question. I'll start and then
Totally.
jump in with anything I miss. So I think we've hit a couple of the key differences just sort of organically through our conversation. One being these are multifamily properties. Modern urban rentals tend to be located in dense urban cores. Single family rentals tend to be located more in suburban areas. We talked a little bit about how these modern urban rentals really are, workforce housing, and we're very focused on sort of helping preserve that. But I think there's a couple other good differences to highlight. One being the environmental efficiency of modern urban rentals. The fact that they aren't single family rentals, they're tend to be wood frame buildings, really makes this asset class, even before we do our environmental upgrades, a fairly environmentally efficient asset class. So there's sort of one other big key difference between modern urban rentals and single family rentals. In terms of, overall advantages to the strategy, I would say because modern urban rentals are located in dense urban cores, it tends to be in supply limited markets. And because they're naturally occurring affordable housing, we're targeting sort of that 80 to 120% area median income, which means that we have a really large target tenant pool. And so we're at 97.5% occupancy for the overall GromaREIT portfolio right now. We have turnovers that happen in less than 24 hours because we are have basically no downtime in between lease transitions. And so I would say that's sort of another big advantage to the modern urban rental strategy versus the single family rental strategy. Any other points that I missed?
I think you nailed it. That's pretty much the core of it, and hopefully to everyone listening in, give some of the reasons why we're so excited about this specific asset class.
And I appreciate that answer. Actually, we just had a question come in that I was going to steer this final 5 minutes towards, so let me go ahead and just ask it verbatim. Awesome. And so just curious, this is actually not part of it, but I'm curious about the answer. How do you utilize debt to purchase any of these properties? And then after we touch on how you gain the liquidity to make the purchase. Second is, what does the investment process look like? Make it a little bit more tangible for the investor with avoiding the terms. Anyone should be encouraged to visit the offering page to look at the terms themselves. But how does someone invest in this fund? Let's see if we can make it a little more tangible for the investors.
Perfect. Yeah.
Do you want to tackle debt, and then I'll tackle
you get the fun process? One? Yeah. Absolutely.
All right. On.
I'll take debt. So that's a great question. Thank you to whoever asked that. So we use debt and use leverage in a somewhat nuanced way, depending on the underlying asset and market conditions. So probably worth starting from first principles on how we think about leverage. In the real estate industry, many of you may be familiar with this, many of you may not be. There's a concept of positive leverage and negative leverage. Positive leverage is generally when your yield on an asset is greater than the interest rate you're paying for the debt. Negative leverage is the inverse. We are always buying assets when we're using leverage with positive leverage. That is a comparatively lower risk approach. And because we're buying assets that already exist, right? They're not ground up developments, because they're often already tenanted. They have residents in place. Maybe they still need upgrades or need improvements. So there's a greater rent that could be earned with a greater product if we improve the property, but they have some cash flow in place. And because we have 7 really strong banking relationships ranging from Morgan Stanley and Chase all the way to really strong regional bank relationships, Needham Bank, Hingham Bank, Harbor One, and others, we're able to get really advantaged debt terms that enable us to be flexible with each asset. In 2020 and 2021, when interest rates were a lot lower, we were using much higher leverage, sometimes up to 65% LTV, loan to value ratio. Now that interest rates are higher, even though cap rates have gone up, so yields have gone up, we've been using lower leverage. Again, depends on a deal by deal basis, but all the way down to 0%, right? Buying things with all cash within the REIT, up to, probably closer to 50 to 60% on average for more recent acquisitions. That we think blends the right level of using leverage to enhance growth and returns of the REIT without over leveraging or dipping into negative leverage territory, which would just be a little bit riskier than the strategy that we're shooting for would necessitate. We really try to blend kind of a growth and income strategy, a little bit of leverage and growth from asset appreciation in the early years, stabilizing into cash flowing, strong yielding properties with consistent distributions as each asset matures. And with that, the perfect segue into.
I was going to say we also probably worth talking about our focus on fixed rate debt. Just if anybody has been reading headlines, there's
yes, yeah, that's a great point. So we have a great advisory board who you can read all about on our offering page. But one of them, Jeremy Sklar from WS Development, gave us a great catchphrase for how to use leverage intelligently at the beginning of Groma's history, which was go long, go low, go limited, long duration with fixed rates. So you're not playing a variable interest rate game, and all of our debt tends to be long term and fixed rate. Those rates do change over time, right? There's only so much you can do about that, but at least that way you're buying the asset with a known rate in place, and you can make a more confident decision about whether it's the right thing to do. Go long, go low, low leverage, right? You never want to over leverage things. And limited, that doesn't necessarily impact potential investors on the call today, but there it's in regards to limited recourse. All of the debt that we take is, of course, recourse to the REIT itself, and any investors are fully protected from that. It's the REIT's liability, and the REIT tries to make the right decisions about how to use debt intelligently.
It wouldn't be a good webinar if we didn't give you a good catchphrase to take home. So in terms of what the investment process looks like, I know Greg will point everyone back to the offering page on Republic. So that's obviously a great way to learn more about Groma and how you can invest in the GromaREIT. You can also reach out to me at investor-relations@groma.com and set up time to chat. I would love to say hi to any of you. I think from an investment perspective, it's probably helpful for me to talk a little bit about what the GromaREIT's goals are. And Seth hit on this a little bit when he was answering the question about debt, but our goals are really to pay steady dividends to our investors and to preserve and increase sort of your principal investment. And we talked a little bit about this when we were going through sort of the case study of how Groma's tech stack sort of improves the value of an individual building. But that's really our goal for the REIT as a whole. Use technology to increase the cash yield. That's going to be, from an investor perspective, sort of correlated to the quarterly dividends that the GromaREIT pays out our investors. And then, preserve and increase your investment is really tied to increasing the value of the underlying assets that the GromaREIT owns. So those would be the key things that I would be looking at from an investor perspective. And again, if you want to learn more about the investment process, check out the Groma offering page on Republic, and please feel free to reach out to us directly as well.
Wonderful. I did provide the email address here in the chat roll,
great.
as well as the offering page once again. So yes, everyone who's tuning in, please visit the offering page, get in touch with Christina and Seth as well. They would love to chat all things real estate innovation with you. We are at our time. I would love to give it over to you guys just for another 30 seconds, minute, if you want to give us some closing remarks. Definitely see a podcast in your future. Also, yeah, exactly. Go low, go long. And that'll be what it's called. But this has been really fascinating for me. I've learned a ton, and I'm sure others have as well. I'd love for you to give us some closing remarks before we wrap up.
Yeah, absolutely. Happy to dive in. So first off, thank you, Greg, and to Republic for facilitating this. Appreciate everyone dialing in and listening. And if I was going to leave any thoughts, we would obviously love to continue the conversation with each and every one of you about the GromaREIT. We're really excited about the innovation that we can bring to the real estate ecosystem, and hopefully, take a somewhat overlooked asset class of a million or so 2 to 20 unit buildings and make them run better for residents, make them perform better for investors, and make that an opportunity that anyone and everyone has access to own part of the city around them. We're hard at work. We're based here in Boston. If any of you are in Boston, you can always come by and see us in the office, but we're hard at work trying to make that happen, and looking forward to a really exciting rest of this year and a few years to come thereafter.
Yeah, and again, follow us on our Republic campaign page. We'll be posting some of the other thought leadership and research that our team is doing over the coming weeks, as well as some other fun updates and some visuals of the inside of MUR. So there'll be some exciting updates there. And yeah, thank you, Greg, and thanks to everyone who attended the webinar. It was a lot of fun.
I agree. Definitely agree. Thank you to you both, Seth and Christina, for hopping in, and for your team as well for manning some slides, putting all the prep work into this. So really fascinating to meet your team. I would love to meet you in person very soon. Thank you to everyone who has joined us virtually for this webinar. Reach out to them with any further questions on the offering or about their company. And with that said, we'll let everyone get back to their day. Thanks again for hopping in.
Thanks, Greg. Bye, everyone.
Cheers.
Bye, everybody.